Tech and SaaS Daily Report, February 14, 2026. Disclaimer: this report is for informational purposes only. It is not legal, medical, financial, or official advice. These are news stories, not guidance. Do not treat any anecdotal developments mentioned below as advice. 1. Databricks declares SaaS irrelevant as it hits a $5.4 billion run rate. Databricks delivered one of the most consequential strategic statements in the modern software era. CEO Ali Ghodsi publicly argued that SaaS is not dead, but AI is making the category irrelevant. This wasn't a throwaway line, it was a deliberate reframing of Databricks' identity as an AI infrastructure company, not a SaaS vendor. Verified financials and growth signals. $5.4 billion revenue run rate, up 65% YOY. $1.4 billion plus of that revenue is directly tied to AI products. Closed a $5 billion raise at a $134 billion valuation, plus a $2 billion loan facility. Deep strategic analysis. Databricks is executing a textbook valuation pivot. SaaS multiples have compressed due to AI disruption. AI infrastructure companies are receiving premium valuations. By distancing itself from SaaS, Databricks positions itself alongside hyperscalers and AI model providers. This is not just branding, it's a signal to investors that Databricks is part of the AI CapEx supercycle, not the SaaS slowdown. Industry implications. Reclassification risk: data platforms may increasingly be valued as AI infra, not SaaS. Competitive pressure: subscription-based SaaS companies may face valuation compression. Acceleration: Databricks' growth suggests enterprise AI adoption is happening faster than analysts projected. 2. Tech stocks enter free fall as AI threatens software revenues. The market narrative around AI flipped violently in the last 24 hours. For months, investors believed AI-driven CapEx would lift the entire tech sector. That belief collapsed as traders realized AI may reduce revenues across a wide range of software companies. Key drivers behind the sell-off. AI can replace, not just enhance, enterprise software. Palantir executives argued AI can now write and manage enterprise software, threatening traditional vendors. Investors fear a collapse in demand for legacy tools as AI agents automate workflows. Deep structural analysis. This is the first time AI has triggered a market-wide repricing of software companies. AI is now seen as a competitive threat, not a universal tailwind. The market is shifting from AI lifts all tech to AI disrupts most tech. Companies are being evaluated on AI defensibility, not revenue growth. Implications. Expect a flight to AI-native companies. Traditional SaaS firms may face margin compression and pricing pressure. Software companies must demonstrate AI differentiation or risk being repriced downward. 3. Anthropic's Claude Cowork sparks a broad SaaS sell-off. Anthropic's release of Claude Cowork, a suite of AI workflow agents, triggered a broad sell-off in SaaS and data provider stocks. These tools automate tasks that many SaaS companies monetize as core products. Capabilities of Claude Cowork. Legal research. Technology research. Customer relations. Complex professional workflows. Deep analysis. Claude Cowork is not a chatbot, it is a workflow automation engine. This matters because SaaS companies often monetize structured, repeatable workflows. AI agents can now perform these workflows autonomously, reducing the need for specialized SaaS tools. Investors are reassessing which companies can coexist with AI agents. Market reaction. Executives claim fears are overblown. Analysts warn of long-term pricing pressure and margin erosion. Investors are shifting capital toward companies with AI-native architectures. For the SaaSpocalypse, software index craters 15% in the worst drop since 2008. The S&P North American Software Index collapsed 15% in a single week, marking the most violent contraction since the 2008 financial crisis. This event wiped out $285 billion in software market value. Catalyst: Anthropic's autonomous legal agents. These agents threaten the seat-based revenue model that underpins most SaaS companies. Thomson Reuters fell 16%. Microsoft hit 3-year valuation lows. Deep analysis. This is the first AI-driven market shock comparable to a financial crisis event. Investors now fear AI will replace software, not enhance it. The market is pivoting toward AI-native firms and away from legacy providers. This is a structural shift, not a temporary correction. Implications. SaaS companies must integrate AI agents or risk obsolescence. AI-native platforms will dominate enterprise workflows. The SaaSpocalypse narrative is gaining credibility. 5. Governments invest in fusion while SaaS faces AI uncertainty. A broader tech outlook report highlighted 2 major themes. 1. Governments are investing heavily in fusion, including a $35 million investment in OpenStar Technologies. 2. The SaaS industry is increasingly concerned about AI-generated automation replacing traditional subscription software. Deep analysis. Public sector investment in frontier tech continues despite SaaS volatility. Policymakers are beginning to discuss AI's impact on labor, software markets, and enterprise productivity. The SaaS industry is now part of a mainstream policy conversation, not just an investor debate. Implications. Government funding may accelerate AI adoption even further. SaaS companies must adapt to a world where AI agents replace subscription workflows. The divide between AI-native winners and legacy SaaS providers will widen. Video tags, SEO optimized. Tech News February 14, 2026. SaaS News Today. AI versus SaaS. Databricks AI. Anthropic Claude Cowork. SaaS market crash. AI agents enterprise software. Tech stock